When people talk to me about investing, most seem to want additional cash flow. That is very important to them. And while cash flow is very important in investing, there's a whole different point that people miss. And to explain this in more detail, let's look at the following slides. Let us say we look at real estate now as an asset class, and specifically at an apartment. And the price of this apartment is $650,000. Now, if we want to rent out this apartment, and we'll get in rental income of, let's assume 3%, that is a cash flow, and that translates annually in $19,500. And the equivalent of a cash flow in a different asset class, stocks for example, is a dividend. And the dividend payment is made to shareholders, and it's just the same thing, a cash flow. Besides the cash flow, there is another return component though. And this return component is the appreciation income. For example, the apartment can increase in price, not 650,000, but increases by 10%, for example. Then this income does not show up in any bank account, but is still an income. And that is the appreciation. And the 10% translate into $65,000. The equivalent of a appreciation in the stock market is just the increase in the price of the shares. To best understand why cash flow isn't everything in investing, we have to look at the concept of total return. Total return is just the sum of the cash flow and the appreciation, so two income parts. So we have 3% cash flow income, and if we add the additional 10% appreciation income, we get a total return of 13%, or in other terms, $84,500. The income through appreciation is more than 3 times higher than the cash flow income. When estimating an investment return, we therefore cannot just focus on cash flow. We also need to consider the income by appreciation. If you like this video, please leave a like, subscribe to the channel and ring the bell. And also let me know in the comments whether you think cash flow is most important in investing, or if you think that appreciation income is the most important. Framed in a different way, why is total return so important in investing? Now, if we only focus on cash flow income, we risk that we overpay for assets because we ignore the appreciation income part. So if we overpay, we are at risk to get a total negative return because we can only sell the asset at a lower price than we bought it. So if we overpay by 10%, this means that 10% is not a positive return, it's a negative return, and it eats up all the cash flow income of 3%. So our total return is negative 7%. When I look at all my successful investments, cash flow was important, especially in real estate. But the most important part that drove my returns was definitely appreciation income. Cash flow income seems more real because the rental income shows up in your bank account every month, so you see it directly. Appreciation income, on the other hand, is less visible, but is just as real as cash flow income. So ignoring appreciation income is dangerous. And this is why cash flow isn't everything in investing, and you always have to look at the total return that you are getting. If you are interested in how to become a better investor, please check out my 6-part free video course, Investing Unlocked. And there will be a link in the description below the video. And if you just click it, it will bring you immediately to the first video. I hope this was helpful to you. Thank you and have a great day.